Hey, it's Jim, and this is FRM Part 2, topic on credit risk measurement and management, and the chapter on credit value at risk. We've had lots and lots of conversations about value at risk, and it is a pretty effective risk management tool. Recall that you can compute value at risk for almost any investment. In fact, I had a little exercise this morning. I decided to get out my Excel spreadsheet, and I started at the very top, the value that we paid for our house. And we've been in our house for 20 years or so. So down 20 cells later, I put what my wife says we could sell our house at. And I went back in and just put some random numbers in between there. Of course, they're all increasing. And so my value at risk for my home was about $87. So that's a totally meaningless risk management tool. That's why the emphasis on value at risk is almost always on equity securities, especially for someone like a pension fund manager who has to worry about fulfilling the obligation to not only current retired workers, but also those future ones. So that value at risk is super important for lots and lots of institutional investors. So then the question becomes, well, can you use value at risk for fixed income securities? And the answer is, of course, yes, you can. So you can apply value at risk for fixed income securities just like we did before, like my house or the pension fund manager, or you can do what we're doing here inside of this chapter. You can call it something different. Credit value at risk is just a specific type of value at risk as it applies to fixed income securities. So what do we need to worry about? We need to worry about things like interest rate risk. We worry about things like default risk. We worry about things like spread risk, and maybe some other things in there. So we'll talk about all of those topics during the course of this relatively short slide deck. So the learning objectives, look at that first one. I think I just helped you compare market and credit value at risk. So we'll have to calculate. So let's have our calculator handy. Remember, in a previous chapter, we did a transition matrix for the bond ratings. We'll come back with that. And then look at the next two learning objectives. This is probably the bulk of what I believe are the better exam questions for this particular chapter. We'll talk about the Vasicek model. I love teaching my students the Vasicek interest rate model, which we don't do here, but he did that interest rate model, and then he did this thing that we're going to talk about today. And then we'll do CreditRisk Plus and CreditMetrics. And then we have just one or two slides on credit spread risk. So there we go. Let's go ahead and start with a comparison. So this is what I was saying earlier. Market risk deals with losses due to market price movements. And historically, that pretty much meant equity securities. But now, when we switch over to fixed income securities, we can still compute the regular old market value at risk for a fixed income portfolio, but we're worried about more things, right? When you own an equity portfolio, you don't have to worry about defaults. You don't have to worry about a credit upgrade or a downgrade. So that's pretty much what we're doing here in credit value at risk. So get out your phones. Here's a really great slide to take a picture of. These are really good exam questions here. Time horizon. When we look at a pension fund manager, that pension fund manager is worried about maybe not 1 day time horizon, but whatever the next payment is due for all of the retired employees. Maybe it's a week, maybe it's 2 weeks. But other institutional investors like wealth managers and maybe some other kinds of institutions, an endowment fund, they might be interested in even shorter days. So remember, market value at risk, think about that as pretty short term. With credit value at risk, what we do is ask ourselves the question, hey, what is the probability that this particular fixed income security is going to either default or be downgraded over the course of that time period? So 1 year makes sense, maybe 3 years, maybe 5 years. It's tough to say. Remember I told you guys that 20 years ago or so, Coca-Cola and Walt Disney issued a 100-year bonds. So there's still, 80 years, 75 years left on those things. So really, do you want to calculate a credit value of risk for 52 years? Probably not. So let's keep it in the interim time period, probably 5 years. Now we know this historical sim, Monte Carlo sim, variance, covariance method. We'll call that the parametric method. We can use all that stuff, but what we want to do is we want to add some more layers to it. So we're going to add the layer of the transition matrix. We're going to look at the Vasicek model. We'll do credit risk and credit metrics. There we go. Market price volatility, default risk. So changes in credit quality, impact on credit spread changes. So what was I saying earlier? We're worried about, interest rate risk, default risk, and spread risk. So that's all incorporated there. And then calculation basis, historical price movements. But over here, we're going to do historical default rates. So in previous chapters, we had conversations about things like probability of default and hazard rates. We're going to use those kinds of things. It'll be a little similar. We'll change the names around here in this chapter, but they're going to be very, very similar. Used by traders to manage daily or weekly market risk. Here, long-term credit exposure. So that should make perfect sense. You guys take a picture of that. Keep that in your back pocket. All right, how about we define and calculate value at risk? So there's a big old graph. We've seen this a million times. There's the normal distribution. So we draw a dotted line down for the most likely value. And so what are we worried about? Here, when we talk about value at risk, we don't care about the upper tail. We don't care about that 50% on the right-hand side of the expected portfolio value. We don't even care about a portion to the left of that expected value. What we care about is the tail. So this is what we're doing. The tail over this next time period, let's say it's a year, we want to know what is happening down there on that left tail. So think of events that are, maybe 2, greater than 2, maybe 3, maybe 4 standard deviations away from the mean. And so what we're going to do is we're going to calculate this thing that we call the unrecovered credit loss minus the expected loss. Now, we've calculated expected loss multiple times. So let's go ahead and work through an example. Look down at the bottom there. There's expected loss. We've done that before. Probability of default times the loss given default times the expected exposure at default. But what we're concerned about then, let's look up at the top, this unrecovered credit loss. So this is nothing more than an excess of the expected loss. So it might be a better term if you just think about it as, look down at the bottom, expected loss, and then up at the top, excess loss. Here, let me go back here. So expected loss, we hit that value at risk point, and then the excess loss is everything that goes to the left of us. And by the way, and you guys know this probably better than I do, that there's a unique distribution inside of the tail all by itself, which is a conversation for a different day. All right, so let's go ahead and work on that example that I promised you. Here we have 1-year bond, principal of 100 million euros, probability of default 4% over the next year. And we'll go ahead and look at ratings matrix here in just a few minutes. So that 4%, we'll just take that as given in the problem. Recovery rate, 90%. So I want you to think about just the quick math here. So if we invest in this bond, we're going to recover 90%. So really, our at-risk exposure is really just 10 million. Multiply that by 4%. So a naive individual might think, okay, what is 4% of 10 million? What is that? $400,000, right? So there we go. That sounds to me like value at risk. But what we need to do is we need to adjust it for a confidence level. So look down on that fourth diamond point. With 99% confidence, we know the market value is going to be 95 million. So calculate the bond's implied 1 year 99% credit value at risk. So look at step 2 first. There's that expected loss. That's what I was just saying earlier. Just multiply, do the math that I just did there. You get $400,000. But then let's go up to the top and let's figure about this unrecovered credit loss. We're going to take the original 100 minus the 95. Here, let me go back here just quickly. Where was I? Right here. All right, so there we go. Percentile. So let's go back here. So there we go. We get the 100 minus the 95 times 1 minus that recovery rate. So that's the 500,000. So take the difference between the two. And let me go back here again. Let's just take the difference between the two, 500 minus 400. And that's going to get us our $100,000. So there's our implied 99% credit value at risk. And so you could see how GARP might change this on an exam. Of course, look at that fourth diamond point. That confidence level could change to 95% or 97.5% or 90% or 50%. I mean, that doesn't make sense, but it could be 50%. And then, so with each drop in confidence, right, 98 to 97 to 95, then that euro 95, that would change as well. All right, let's go ahead and look at these transition matrices. And we did this just, maybe it was even the very previous chapter that we discussed. So all we're doing is saying something like, okay, here we have a bond and it has this rating, say a single B rating. What is that rating going to be by the end of the year? Is it going to be a AAA rating? Is it going to be a D rating? Is it going to be some other crazy rating out there? So here's this ratings transition matrix. So let's just go across on the top. Forget about the green and the blue and the red here in just a second. So look up at the top there. We've got 89.85. So if 100 bonds are rated AAA at the beginning of the year, then by the end of the year, only, can I round up? Only 90 of them would remain at AAA, and then 9 point something, let's say 9 or 10, would fall to AA, and then look, hardly any fall to single A and triple B all the way down there. So that's how you read this ratings transition matrix. And so we have the green and the blue and the red. And so think about a bond that starts with an A rating. It has a 92.61% probability of remaining there. It only has a 0.03 chance of moving up to AAA and a 0.2% chance of moving down to BB. So I'm guessing that a great exam question would be, well, suppose we have a single A rated bond at the beginning of the year. What's the probability that it will be have a rating of BB by the end of the year? And there you go, 0.27. So look at this whole matrix. In fact, you know what? Get your phone out and take a picture of this, just so you can practice this over time. But notice that as you move down, can I call those, if this is a variance covariance matrix, if you move down the variances there, notice 89%, 90%, 92, 91, 86, 85. But then if you're triple C, if you're any kind of a C bond, you only have a 50% chance of remaining a C bond. What's your best chance? Your best chance is moving over that way into default. So if you're a triple C rated bond, then forget about it, right? Is that a comment that they made on The Sopranos? My cousins watched The Sopranos 3 times. All right, so how do we calculate this for long terms? Remember I said this earlier? I said, here, let me go back here. So this is 1 year, and I said that the tradition for figuring out, these things like, probabilities, this is going to help us with probability of default, is that we do it at the end of year 1. But I also said, boy, we really don't want to go out to 65 years for that Coca-Cola bond, but we might want to go out to 3 years or 5 years, So there we go. Let's go ahead and do a 5-year transition matrix. So up at the top, there are the first 3 rows of our previous slide. But then we have similar but different. Notice in red, rating at the year end. Now we have a rating after 5 years. So notice that if 89 of those bonds remain AAA after 1 year, only 59 of those remain after 5 years. So what does that tell us? That tells us that there tends to be ratings deterioration over time. Over time, firms become less and less likely to be able to meet those payments, interest and principal payments. And so, by the way, I can't imagine that they would ask you to do this, but they could clearly, GARP could give you the first one. So here, get out your calculator. Let me do this. Let me do this with you. Got to take my glasses off. So do 8985, but do it in a decimal point, 8985. And then raise it to the 5th, right? We're doing 5 years. So do 5y to the x, and you get the 5892. So the GARP may ask you to transform year 1 ratings probabilities to year 3 or 5. So just raise it to whatever the period is. That should make perfect sense. All right, so let's take a deep breath and figure out that what we did was relatively simple. So let's go ahead and try to complexify things with this Vasicek model. So look at the orange arrow point. What we're trying to do is come up with the worst case default rate. So that just means the default rate in the worst case, right? Hey, Jim, thank you for changing the words around to explain what that term means. So all we're trying to do is figure out what's the worst possible thing that can happen. And I'll show you an example here in just a second. But I want to give you a little background, and this will be very helpful here when we talk about this Vasicek's Gaussian copula model. But it's also going to be super important in future chapters when we address the copulas and what they mean. So here's my example. So I want you to know this now, and this has some applications to what we're doing today, but even more to what we're going to do in a future chapter. So think about a simple married couple. So here we are, my wife and I, and we show up at the insurance agent's office, and we say we each want a life insurance policy. So the insurance agent asks us a bunch of questions. You know, I'm 62, my wife's 58, so we do all this kind of stuff. We answer all these questions. No, we don't smoke. Yes, my wife drinks 2 glasses of wine a night. So we do all that. But the important thing here is that there's a distribution, a unique distribution, because, you know, I'm this stuff and my wife is that stuff. You know, so we can look at those distributions and we can compute their marginal distributions. But then the insurance company is going to ask itself the question, well, are those two events independent? If Jim's wife dies, is he going to be so distraught that he's going to just deteriorate and he's going to die? Are those two events independent or are they dependent? Well, traditional insurance kind of models say that those two events are independent. So what you do here in this Gaussian copula model is you take these two marginal distributions and you lay them on top and you get a joint distribution. And that's what this copula is, that joint distribution. Now, the problem with many of these copula models is they continue to assume that they're independent events. But we know, in fact, that if whichever spouse dies first, it cuts off a certain number of years with this surviving spouse, whatever that is. So clearly, those two events are not independent. Although my wife has said to me, she goes, you know, Jim, if you go first, I'm going to have the greatest time of my life. I'm just kidding. All right, so think about that copula model, and we're trying to find out this joint probability, which then leads us into this default rate. So this is going to help us compute. Here, I'll show you this right here. So look down at the bottom. We're going to compute the credit value at risk. All right, so let's go ahead and take a look at this. So what do we need? We need probability of default, just like we did before, and we need the credit correlation parameter. And that thing is this, well, it could be just a regular old correlation coefficient, or it could be the Gaussian, which is, you know, just mean and standard deviation, normal distribution stuff. It could be this, the copula, right? All right, so let's go ahead and work through all this. Now remember, we've got an N, so that N thing there with the big parentheses, that's what we used in the Black-Scholes-Merton option pricing model. And then the N to the -1, that's the inverse of that thing that we used in the Black-Scholes-Merton option pricing model. So that's the inverse cumulative distribution function as opposed to just the cumulative distribution function. So we're going to have to look up numbers on the table. All right, you ready for this? So here's our example. Let's suppose that we have 100 million. 1 year probability of default, 2%. Recovery rate averages 40%. Estimate 99.5% 1 year credit value at risk using the Vasicek's model. If the copula correlation parameter is 0.2. So at this point, we can just think of that as just a regular old correlation, but it's going to be super important when we lay those two marginal distributions on top of each other. All right, so that's 0.2. And by the way, you can interpret that just like you do a regular old Pearson's correlation coefficient, but of course it's much more complex in its computation. All right, so you're going to have to memorize this formula, of course. So go ahead and let's inject the 0.02 for probability of default. And there is the correlation parameter, 0.2. And then there's the confidence level, 99.995. And then we're going to divide by 1 minus that correlation parameter. So all we need to do is we just need to look up on the table what is first of all the inverse. Here, let me go back here. What is this inverse cumulative distribution function given the input variables from the question stem? All right, so notice we go from 0.02, and then notice at the next step we have a minus 2.05. So what we've done for you is we've gone ahead and put together one of these Z tables, but I always like to use the D tables from the Black-Scholes-Merton because they give you both sides. So you have the minuses over here all the way to the pluses over there. So what we're going to do is that, here, let me go back here, that inverse cumulative distribution function, we know that that's 0.02. So what we need to do is we need to go find 0.02 on the table. So look on that second column over there. Gosh, I have to do my glasses here. Yeah, so it's about 0.0202, right? So that's about 0.02. So the corresponding Z value, now this is D because Black-Scholes-Merton knew that the Z was already taken, so they changed it to D. So there's where we get the minus 2.05. And then let's go to the 995. So let's find that all the way over on the right-hand side. I've circled that for you. So look at those cumulative numbers there. So what does that say? 9946, 9953. So it's not quite 995. We don't have the exact table. So it's somewhere between 255 and 260. So, whoops, I went the wrong way there. So it's 2.58, right? So there we go. 2.58. So if you do all that stuff, you get 1.49 minus 1.49. And then, now I didn't circle this for you, so I'm going to let you guys, for those of you who aren't experts on the table, go ahead and find the 1.49. So just run your finger down, until you get to, well, notice the number 1.49. So, do we get 1.49? Well, we don't really have 1.49, but we have something pretty close to it. So I'm hoping you guys can find that somewhere over there. And so you get 6.8%. So we take that number, and we use that in the credit value at risk equation. So that's going to be our worst case default rate, right? Our worst case default rate. And then we're just going to multiply it by our exposure, 100 million, right up at the top. And then our loss given default. And all we need to do there is multiply by 1 minus the recovery rate. So what do you get? $4,086. So that takes care of that learning objective to go ahead and compute we've done it now 2 times, right? So 2 times calculate this credit value at risk. Really, really good stuff. Now, note that this model, this Credit Risk Plus model, was developed in 1997. So what was going on in 1997? Gosh, I'm guessing you guys were born by 1997, but some of you probably were not. So I want you to think about this. We had tremendous economic expansion in the Bill Clinton years in the United States. So we had massive growth. This is also the time period in which we had massive growth in the derivatives, financial engineering of the creation of products, and then in derivative markets. So we needed more stuff, right? We needed more stuff. So CS developed this in 1997. And what it did was it took the insurance industry metrics and and models and threw them into the Vasicek's model. Now, when I flip the slide here, you're going to say, you know what, Jim, that doesn't look anything like the Vasicek's model. And I concur that it does not. But there are some similarities. Notice at the bottom, there is a default probability and there are total expected defaults, which is aggregate default probability. So we're still in the same kind of a ballpark here. But what we're going to do now, here we go, default distribution. We're going to go ahead, there's our probability of default, M defaults. Remember now, we've got this fixed income portfolio with maybe 100 bonds or 1,000 bonds or 1,000,000 bonds, probably not 1,000,000 bonds. And so notice what we're going to do. We're going to use our little e raised to the minus thing. Forget about the ratio there on the top right. But just look at this thing. So we have a default probability, which is going to be like 1% or 2%, right? And then an n, which is whatever n is. So what does that mean? This is almost exactly like what we did for present value. What did we do? We took e, we raised it to the minus I times t. Interest rate, which is decimal form of the interest rate, and t, which is the number of time periods that are being compounded. So essentially, and boy, I don't want you to tell your finance professors this, so I'm going to deny all of this if a finance professor ever comes up to me. But essentially what we're doing here is we're computing some kind of a present value. But it's not a present value in terms of interest rates. It's a present value in terms of default probabilities. And then what we're going to do in that big ratio over on the top right, we're just adjusting it for however many defaults that we think are going to occur inside of the portfolio. So think of that ratio as just some kind of an adjustment. And I'm going to do an example here in just a second, but what I want to show you is this incorporating uncertainty, which means that we're really going to introduce another distribution. So look at the second diamond point where it follows a gamma distribution, has a mean, and it has a standard deviation, whatever those things are. So if you look at that equation there, the good news that I can give you is that in this chapter, and I hope you guys look at the chapters because I really think they're super valuable before you watch my recordings. But what the chapter does for you is it goes through this and it says, okay, let's work through an example. And the chapter gives you a big old table. And so they use this equation and they do this big old table and they give you some numbers. And then they say something like, you know what? This would be better suited for Monte Carlo simulation. So I think this is probably the good exam question. Let's go ahead and do some calculations with the top equation. And then let's be aware that if we run into a gamma distribution, if we run into uncertainty, let's just remember for the exam, it's a massive problem for them to ask you to use that equation. So they're probably going to ask you to use Monte Carlo. And then you'll know Monte Carlo because we've talked about that for a million times. All right, so here's our example. 1,000 loans, 1% annual probability of default. What's the probability of 15 defaults in a year? So 15 out of 1,000. And remember, we're not identifying those 15, right? We're not identifying those 15. It could be any 15. And that's why, and I forgot to say this back here. So look at this. If you do this up at the top, large number of loans, small default probability, this then approximates this Poisson distribution. And that's really what we're saying here. And so all we're going to do is we're going to input and we're going to go ahead and get, what do we get? We get 3.4% probability of 15 defaults. Now, what I want to do, at the risk of offending you, is I want to take you through the math here. So, you ready for this? Let's go ahead and work on the upper right ratio. Let's do that first, and then let's put that in our memory. So let's do 0.01. Let's hit our enter button. And then what are we going to do? We're going to do 1,000, and we're going to multiply. And then we're going to do 15 y to the x. So we're going to get some big old number, right? So let's put that in our storage. So let's do a store 1. And by the way, those of you who have the Texas Instruments, your buttons are just exactly the same, except you have to hit equal sign. All right, so then let's clear. So that's in our first storage, right? I hit store 1, didn't I? Let me do that again. So store 1. So let's clear that, and let's do the denominator. Let's do 15, and let's do n factorial, which is a blue right there. So there's that big old number. All right, so then let's do this. Are you ready? So let's do that. Let's do recall 1 divide, and then we need to hit our 1 over x button. So there's 764. That's that big thing on the right hand side. So let's put that in our second storage. So let's do store 2. Okay, so now we're back to just regular old time value of money stuff. This is why I was telling you that this is kind of like a present value. I mean, it is a present value factor. All right, so what are we doing there? We're going to do minus 0.01, hit enter, change the sign, and then multiply that by 1,000, and then hit my blue e to the x, and then I'll do recall 2 times, and that should be it. There you go. And I round. So mine rounds to 0.035, but if you have a bunch of decimals in your calculator, you'll get 0.3472. And by the way, I always like to have my calculator set at 3 decimals, but clearly there are some questions on the exam that you're going to need more than 3 decimals. So you might want to do how do I do that here? If I did like that, there you go. Boy, that gives me a migraine looking at all those decimals. So now remember that back here we had, where was I? What was that, 1997? So here's CS, and they're doing this credit risk plus model. Its competitors right down the street at JP Morgan, 1997, are saying, hey, you know what? What happens if we add downgrades into this model? So that's the big deal here with CreditMetrics. It does defaults and downgrades. Now look at the fourth bullet point. This is great news for you guys. Utilizes a Monte Carlo simulation. So here are the stages. What are we doing? We're going to divide the time until the end of the longest transaction, right? So you got how many bonds, how many maturity dates. So you put this into intervals, right? So for each interval, you calculate the present value of that net exposure, similar to what we've been doing so far. You determine that credit rating, and then you calculate that credit loss. And then you can do this a variety of ways. You probably want to use some kind of a term structure, and you probably want to use credit spread. So I would remember those simulation steps. So where are we applying this, right? Credit loss distributions and value at risk. I mean, that makes perfect sense, right? So what this means then is that somewhere in all of this, we're going to have some correlation coefficient. So what we want to do is we want to account for interdependencies. Of course, we want to calculate for that. I always call it co-riskiness. We're going to use this Gaussian copula. So here we are. Can I do this again? We're laying those 2 marginal distributions on top of each other to get a joint distribution. And so, oh my gosh, look how beautiful this is. Look down at the bottom. What we can do is that we can go ahead and use the capital asset pricing model, because we're going to use that to try to come up with a relationship between and among all of the equity securities, because if these are all bonds for publicly held companies, well, they have shares of stock as well. So we're going to use those correlations that are present in the equity markets to help us with our credit value at risk. Now, how does this model work? So this is very similar to what I was saying to you earlier about my wife and me, a husband and a wife. So here's the example that we have come up with here, trying to guess how 2 students will score on their exams. So this is similar to how 2 bonds will come up with their rating, right? So what do you have to do? You have to know the 2 students, and first of all, how intelligent, right? The IQ of the 2 students, that's important. And then you need to know how they're studying together. Maybe they study together and their synergies at work, and they're leveraging each other's intelligence, and they say, I know this, I know that. And so now at the end, they know everything. Or they could just be the opposite. They could say, oh, you're a moron, you don't know this. All right, so those correlations are super important. So the question then becomes is we have a starting point, and then we ask ourselves the question, what's going to happen during the performance? Is the student going to make an A or a B or a C, or is the bond going to be the same default risk level, or is it going to improve, or is it going to regress, so to speak? Right? So predicting together, so like study buddies here, they're correlated how one company does. So think about this. What was I saying earlier? That my wife and I, if my wife goes before I do, I might die right after that because I'll miss her. My heart will be broken and I won't be able to eat her mayonnaise chicken every night because she's a great cook. So I'm just going to say it's not worth living and my heart gives out. On the other hand, what did she say? Now, I was kidding, of course. She said, hey, dude, if you go first, I'm going to have the greatest time of my life. But what we know is that those things are, they are related. So think about this. If in that, what was our example just a few minutes ago? We had 1,000 bonds. Suppose we had a Walmart bond in there, and then we had a Target bond in there. And the Target bond defaulted because nobody wants to shop and buy the things at Target. Well, the things at Target are the same things that they have at Walmart in general. So if no one's buying Target, then no one's buying Walmart stuff, right? So there's some overlap, and there's where that copula relationship comes into play, right? And so making a guess. So we use that special formula to try to figure out what's going to happen in the future. And then we say, okay, A to B, B to C, triple A, something like that. Now here's this last slide on credit spread risk. So what happens here? What is this credit spread? It's the same thing that it's always been. We take the yield on our bonds and we subtract out the risk-free rate of interest. And so that spread, whether it's, 50 basis points or 500 basis points, that's going to determine, and we can use that credit spread risk to calculate credit value at risk. How are we going to do this? Historical simulation. We can do the CreditMetrics approach. Look at there, a 10-day ratings transition matrix, Monte Carlo simulations. Of course, what are the challenges? Well, if we use historical, then it's, we're going to worry about history repeating itself. And I think that takes us through our learning objectives. What I want you to do now is I want you to go to the end of this chapter. There are 14 really, really good questions. Now, we've done much of the math that is required on those 14 questions. Some of the stuff we haven't done uniquely. So look at the answers at the end of this of these chapters. You'll have to go all the way to the end to get the answers. But you'll pick up on what we've done, so you'll be able to see exactly what those questions are. Many of them are in the Vasicek model, the transition matrix, and CreditRisk Plus and CreditMetrics. So go look at those, and that ought to take care of any good questions that show up on the exam. So hey, thanks for watching. Have a great day, and good luck studying.